Second, we're joined by Terry Mullen, the founder and CEO of Trulytics, who will be walking us through the Trulytics Software as a Service evaluation platform, the simplest, fastest, and most robust way to get an accurate value of your practice. Terry has had a successful 30-year career in financial services distribution as a senior executive with AIG, Lincoln Financial, and Sun Life, amongst others. And his deep knowledge of financial services is now being focused on Trulytics and helping advisors continuously improve their practices. And before we get started, a couple things on the sort of administrative side of things. First, we're going to be leaving some time for questions at the end of the webinar, so please feel free to put questions into the question section of your GoToWebinar app. Second, we want to welcome you to all join us next Wednesday for our next upcoming webinar titled How to Succeed with a Succession Plan, in which we dig into the details of how to move forward effectively with putting a succession plan in place for your practice. Third, today we're going to be attempting something new, and we're going to be trying to walk on a high wire during this webinar and publish a poll for you to answer during the webinar. It's one simple question, a bullet, three answers. You just have to choose a radio button as an answer, and hopefully that's going to go well. If it doesn't, please forgive us ahead of time. And fourth, this is being recorded, and we will make it available for you to review after the session. So we'll send you an email giving you access to that so you'll know how to be able to listen to it and review anything that you might have missed. So for now, I'd like to hand it over to Paul Lally, and he's going to bring us up to speed on discounted cash flow evaluations and what that can mean to your business. So go ahead and take it away, Paul.
Thanks, Kevin. And Kevin, can you hear me okay?
I can. I had just put you on mute, but I can hear you fine.
We'll take that as a yes. Well, hello, everyone. And as usual, I don't see faces, and you're just going to hear my voice for a little bit. I want to thank Trulytics for asking me today to talk about this subject. This subject has become an increasing topic at conferences, an increasing topic for us at Gladstone and Chapel Bridge, as well as creating a lot of questions for advisors who are running businesses today. The question of why discounted cash flow is becoming more in vogue or more talked about is really becoming because of the evolution of the financial services industry, specifically in the independent side. You look at our industry, and for the most part, this is a first-generation industry. We can actually say this industry started back in 1979 when the first graduating class of CFPs got their licenses and set up their own businesses. But you begin to look at the evolution of those businesses very early on in the industry. It was solo practitioners really practicing their trade. They may have wrapped themselves in a business corporate wrapper. But it was really a way to better serve their clients and enjoy a lifestyle produced by that practice. Over the past 30 years, what we've now seen, and it's becoming more evident today, as a lot of these practices are now evolving into businesses. What's the difference? Business has a little more complicated, it's a little more complex, increased infrastructure, increased costs. These business owners now 30 years into their career are beginning to look out the next 5, 10, 15, 20 years, thinking about perpetuating their legacy into the future, because most times their practices or businesses are one of their proudest achievements. New firms, new businesses or wealth management firms are being set up as businesses at this point. And the question has become, well, how do we really value these businesses? For many years, the rules of thumb were floating around the industry. Most people in this webinar today are probably pretty familiar with the multiple revenue approach. And then over the past several years, we started hearing about multiples of cash flow, and now we're starting to hear about discounted cash flow. Well, just as the businesses evolved, the ways of valuing those businesses have evolved as well. So to give a brief introduction to the discounted cash flow, and so there we go. My computer was a little bit behind. When you look at discounted cash flow, the question I would ask everybody on the phone to think about for a second, put your business hats on. If I'm buying any asset that produces cash flow, am I buying that cash flow? Am I buying that business and putting a value on it for what that business has done for the past 3 years? Am I buying and putting a price on this business for what it's done this last year? Or I'm really looking at a price to pay for this business of how that business will perform over the next 1, 2, 3, 4, 5 years going into the future. And as practitioners, as I've been doing this now for 26 years, you look at businesses, and it's very easy. It's not a very complicated process to look at revenue and look at expenses and look at the cash flow and say there's a rule of thumb or there's an industry metric and put a value on it. But what also is involved in valuing a business is the external and internal forces affecting that business. And the question you ask of any purchase is, how sustainable is that cash flow? How predictable is that cash flow? How viable is that cash flow? And then how transferable is that cash flow going forward? So any business is a sum of its parts. It's a sum of the business structure, the owner, the clients, the processes, the systems. And what a discounted cash flow model will do is try to capture all of those elements into producing a value, looking out to the future and bringing that great present value, those cash flows back to today. The value of giving a business, as I said, is some of its parts. You have to be, what we're always conscious of, what elements are important to valuation. And there's two propositions when looking at a discounted cash flow. First, an asset has to have value, has to have expected cash flows that are positive over time. A little different than, I'll use my friends from Trulytics and other technology companies. The technology companies are really based upon the future opportunity value and then eventually producing that cash flow. But for businesses such as wealth management, we would expect those businesses over time to produce positive cash flow to put a value on that asset. The second value proposition is assets that generate cash flow earlier in their life will be worth more than assets that generate cash flows later. The latter may have a greater growth and higher cash flows, but there's more risk to future cash flows than cash flows today. When you're building a discounted cash flow model, the assumptions matter. The risk factors matter. These attributes can be skewed, these valuations can be skewed if I'm making the wrong assumptions going in. If I'm looking at the business risk, the client risk, market risk, if I miscalculate those, they will have sometimes a dramatic effect on the present value. So why use a discounted cash flow model? Why is it important? If you're selling your business, it's important to know how a buyer is going to look at this business. It's important to understand your risk factors going into the future and figuring out how those risk factors affect the sustainability of your business. As a buyer, you want to know, again, as I said earlier, how the cash flows will be affected going forward. I'm buying cash flow. Today it's predictable. Will remain predictable over a specified period of time. We've seen discounted cash flow models be built 3, 5, 7, 10 years. The models we build at Chapel Bridge and Gladstone for privately owned businesses are typically based off of a 5-year projection. It forces advisors to think about the key drivers of value. Again, as I said earlier, when we talk about valuations, a lot of times, the first thing business owners will point to is their income statement. They'll point to their QuickBooks printout. They'll point to their consolidated statements or audited statements. But in privately owned business, it's the non-financial drivers that affect value. To give you examples of these, do you have a succession plan? Now, we think a succession plan in this industry too broadly. We think it's an event somewhere 15 to 20 years down the road. Actually, in succession planning, there's two key components. The ultimate succession plan, 15 to 20 years down the road, is an exit plan. What we have found in our industry is oftentimes entrepreneurs neglect or don't pay attention to the interim plan. The interim plan is what happens to my business should I not show up for work on Monday morning. Is my business sustainable? Will it continue? Will it still remain a viable enterprise? Or is my business at risk of failure at that point? My staff, is it just me running my practice, or do I have key people within my business that can maintain my business? Do I have non-competes and non-solicitation agreements to protect my business from advisors taking clients should they leave? We look at the age, then we look at the age of the clients. We look at the demographic of the clients. Is your client, in the average age of your client, 65 years old, and over the next 5 years, those clients will get older, and those clients will be in more distribution phase than accumulation phase. Are you bringing in new clients to replace those old clients? A big topic for our industry when we look at the sustainability of a business model is the relationship with the next gen. We have found oftentimes with wealth management firms, they've done a tremendous and fabulous job maintaining and building relationships with the first generation, but have done a poor job at maintaining relationships with the next gen. So there's a risk of attrition of assets post the first generation. Discounted cash flow is important for this industry as well, and what we have found is our industry, the wealth management industry, points to metrics. They point to the multiple of revenue approach. Well, the multiple of revenue is 2.1 times or 2.5 times recurring, 1 times non-recurring. And that's the average multiple of the industry. Well, it's funny, we say this to advisors all the time, you don't consider yourself average until you start looking at multiples. And also this industry as well, it's an industry of snowflakes. To put an average multiple in a practice is saying every snowflake is alike. You begin to look at those snowflakes very closely, and there's nuances and differences of those snowflakes very similar to the businesses. You start to hear comps in the industry, well, because this business is at $500 million, it trades at 5 times its free cash flow, or if it's at $250 million, it's trading at 3 to 4 times its cash flow. Here's a big misnomer in the industry. There are no relative comps for our industry. These are pointed rules of thumb. Having been in this industry, again, for 26 years and worked with many wealth management firms, and this is my day job, I am still trying to find a database that can show me the last 50 transactions that were done, not just the name of the buyer and the seller and the assets that were transitioned, but the multiple that was paid and the deal structure of that transaction. It doesn't exist. In Chapel Bridge, which is my general industry business, I can go on and see the last 50 widget company transactions that were done and find comparable multiples to apply to my client. So discounted cash flow becomes very important when you don't believe or trust the standard rules of thumb multiples that are being applied. The discounted rate estimation is the expected return an investor would require from that investment. It perceives the risk of that investment. The higher the discount rate, the more risk that buyer or that investor sees in the transaction. To give you an example, nano-cap businesses, which represents the vast majority of this industry today. There are very few even small-cap businesses. Nano-cap businesses trade going in on a risk factor percentage of 19 to 21% off their public company peers. Why? Lack of real identifiable brand, lack of scale, lack of access to capital markets, lack of the defensive and competitive buffers, lack of succession, lack of perpetuation capabilities. We begin to look at this industry and say, well, wait a second. That nano-cap discount of 19 to 21% would look at this industry and say a wealth management firm is the same as a small widget manufacturer in my town. There are nuances to wealth management and professional services businesses. So we at Gladstone, I know Truelytics does this, which I think is phenomenal. We do this with Chapel Bridge, is we say in professional services, what additional risk factors are associated in a relationship business? The first is the business stability. The business stability is how reliant is this business on its principal? How reliant has the business built a brand? How reliant is the client on that principal? Very simply saying, if that principal didn't show up on work for Monday, how viable is the business model? The second is the client stability. How long have you had relationships with your clients? How often do you contact and interact with your clients? We meet many wealth management firms that will tell you they meet with their clients on a quarterly basis to risk adjust their portfolios so they can meet their retirement needs. When you really begin to press a lot of advisors, they would tell you they meet with their top clients frequently and their smaller clients maybe once a year. How do you market your services? Is your services completely referral-based? I think we saw back in the market turn in 2008 that referrals weren't coming in as quickly as they were before. Do you have a marketing strategy to generate new business? The relationship with the next gen, as I said earlier, is very important. The risk of attrition of assets post-first generation is a big concern for our industry. And then we look at the market stability. We're not telling firms on how they should build portfolios or how they should research their investments. What we're looking at is how correlated is the revenue stream to the overall performance of the marketplace. To give an example, if an advisor is 100% invested in global equities and the market takes a 25% downturn, well, the revenue is now probably dropped close to 25%. But the problem being the expense structure, their costs, their fixed costs, are remaining consistent. So now you're starting to see their profit margin and their cash flow begin to suffer. What are some of the non-financial considerations in determining discounts? The strength and depth of the management team. We have found oftentimes, sometimes in a lot of situations, the wealth management firm has a very capable management team. However, they're not directly involved in the business. A lot of times the management teams are responsible for working with the clients and maintaining clients, but have very little insight or influence on the operations of the business. And therefore, a risk factor becomes, should something happen to that business owner, is the next gen capable of picking that business up and continuing it forward? The capability and intention of the next generation. Are they successors? Are they truly key to the business? Do they want to be a successor? Do they want to be involved at a senior entrepreneurial level? And then the growth in historical projected revenue of cash flow. When we look at value, we look at it three ways. What has the firm done over the last 3 years? If we don't place a value on it, but it gives us trends. We look at the firm, what it's doing today, and we look at the firm, what it will go doing going forward, and how they're going to drive that revenue. The other is industry status. This industry right now, there's about 180,000 registered reps. There's roughly 20,000 RIAs. When we started Gladstone 11 years ago, we could count the number of billion-dollar firms on one hand. Now we need to be an octopus to count those billion-dollar firms. These becoming businesses. Am I in the top 10% of my industry? Am I in the top 10% of my area or my region? But also, have I created a brand? A lot of firms would tell you that they have a brand, but that brand is typically recognized with their client. Their reputation is based upon that brand. But as I make an example, my 95-year-old grandmother, if you flashed a picture of the bull up on a TV screen, immediately she would know that was Merrill Lynch. She wouldn't know anything about Merrill Lynch, but she recognizes the brand. The size of the business. As I said, our industry status and size are one and the same. Am I growing a bit? Am I one of many within my region, or am I one of few? Am I a market dominator, or am I a market participator? And then the client-based compensation. I talked this one to death, but this one is very important. Age, tenure, and the strength of my relationship. And not only the strength of my relationship, is that relationship transferable? The transferability of the revenue stream goes in tandem with the transferability of those clients. Do I have continuity plans in place? We do this every day, and I preach this every day. But again, I wrote an article about 2 weeks ago saying succession planning is a dirty word. Our industry has confused succession planning with one day I'm going to hang up my cleats and walk off the field. The way we look at value, we look at sustainability of the business model, is what do I have in place to protect my business first and foremost upon an unforeseen event. I was just meeting with an advisor before this call. She runs a very nice business. Our husband was her partner. Our husband became ill. Long story short, found out that he had a virus in his heart muscle. Now he's at the University of Pennsylvania in intensive care. And she is now struggling with how she's going to maintain his clients, why he's disabled, and that they're looking at probably a year before he can come back to work. A big misnomer in our industry is you talk to a lot of advisors, and advisors or entrepreneurs, they continually want to grow and build, and they will tell you all the time, I have capacity. We say be very careful, do not confuse capacity with scalability. Can I scale my business? Do I have the infrastructure to add new assets without increasing my costs? Do I have technology that is scalable, or have I have proprietary technology that I've created that is not scalable? Do I have the right human capital in the business? Is my management team scalable, or are they at capacity? We talked to a firm about doing acquisitions. The CEO was all for it. He wanted to do it. He said they had capacity. We met with the management team, and the management team said that's great, but the way we do financial planning in the high net worth space, we could probably do 10 new clients a year, but there's no way we could do an acquisition and bring 50 new clients in today because that platform is not scalable. And then the next one being your corporate tax status. This is an intangible. We meet most businesses. If you're a sole proprietorship, anybody on this phone, I please encourage you to look at a corporate structure, because as a sole proprietorship, you do not have a business to transition. That business will die or terminate upon you leaving or dying with the business. We see many C Corps. We see some C Corps in the business. C Corps for our industry, again, for some manufacturing companies, that's great, but for this industry, C Corps could create a tax problem oftentimes for advisors who are looking to sell their business or buy a business because it is a double taxed entity. Buyers will tell you they do not want to buy the stock of your business, they want to buy the assets. And a C Corp, those assets become tax trapped, and now there's 2 layers of tax to get out. The company pays the tax, and then the individuals pay a tax. We see most common and in this industry either S corporations or LLCs taxed as S corps, or even better, some which we really like here at Gladstone, taxed as partnerships. Organizational, operational issues. The question we ask here to entrepreneurs is, we have a bad habit over time of accumulating what I call hats. We really got into our industry to do 2 things: work with clients and find new clients. We meet with more entrepreneurs who wake up and all of a sudden they're CEO, CIO, CTO, CCO, and they're also the head of business development. Have you created an organization that has spread those responsibilities to other folks to free up the principal to do what they do best? Drive vision and strategy, manage relationships should they want to do so, and generate new business. Portfolio management. Are you doing your internal research? Do you have a black box way of managing money? Or are you using model portfolios? Are you using technology to assist in the creation of these investment strategies? Why we're asking this? Because, again, the transferability of that asset, if you manage money your way and different than everyone else, how can I transfer that knowledge over to me? And then the client service model. Very simply, how do you communicate with your clients? How often do you communicate with your clients? And do those clients recognize the brand of the brand and the firm, or do they recognize the principal? I love this chart. I've been using this chart now for many, many years. The reason I use this chart is the best time to think of value, when most owners think of value, is the time they're afraid to sell. This chart is like a roller coaster, and I say this at conferences, and it's a shame I can't have everybody raise their hand on the phone today and say it, but when most businesses will decide to transition is when the owner decides it's ready to transition. The problem with that is that most times at that transition point, the business is already mature. So if I look at the viable, sustainable, predictable cash flow going forward and growth of that cash flow, we're all intelligent people, financial advisors on this phone. How can I predict a growth of a business when that asset is already matured? There's no more leverage. The best time to sell a business, which is counter to the way entrepreneurs think is actually when the business is almost at the top and not sitting at the top. I always leave this conversation with a couple what I call Mythbusters. The first Mythbuster is valuation is based upon a specific point in time. The answer is no, it is not. We're sitting here now in April. Buyers are looking at businesses, sellers are looking at selling their practices, and are looking at 2016 numbers and saying, at the end of 2016, this is what my business did on a free cash flow basis. When we say free cash flow, it is the net income of the business adding back salary and compensation, perks and benefits of the principal to show a true cash flow. This is what my business is worth, and our first statement is no. That's what it was worth at that point in time. The business is really worth what it's going to look like over the next 3 or 4 or 5 years, and be able to intelligently predict that. So I'm not going to, I think I just said this, and pretty much I want to know how this business is going to perform in the future. Second myth, using a multiple revenue approach is the most commonly accepted way of valuation. Emphatically, I say this, I defend this every day. The answer is no. The reason the multiple revenue approach became vogue a number of years ago was firms started to think about how do I trade this business. The industry, the comparable they pointed to was how CPA firms trade. They look at CPA firms. CPA firms trade on multiples of recurring and non-recurring revenue. The example I would make here is every asset you buy that you expect to generate a return has a profit to it. I don't care what the revenue is. If I'm picking a stock for a client, I'm looking at a company, the revenue is great, but I'm investing in that company because of the predictability of that cash flow. I'm investing in the profit. The average multiple of a firm like mine is X. The answer to this, again, is different. If everybody has a pen on the phone, I will give you the multiples right now, and it proves a bit of a point because I'll wrap them off. I'll run them off so quick you can tell the rules of thumb. Businesses at $100 million to $200 million trade between 3 to 4 times adjusted cash flow. Between $250 million to $500 million, they trade between 4 to 5 times. $500 million to $750 million trade between 6 to 7 times. $750 million to $1 billion trade between 8 to 9, and at $1 billion, it's 10 times plus. When you ask somebody, a consultant who says your business is worth 5 times, ask them why, and you will find most of the time they don't have an answer for you. A 5 times multiple is a 20% going in discount factor on that cash flow. And again, as we talked about this topic of this conversation, those multiples also, why am I at 4 or 5 times? Why am I at 5 to 7 times? If you're buying a business or selling a business, the buyer will never show, typically the seller, the discounted cash flow model that they did, what they will come back to you is show you a multiple based upon that value they arrived at. They will show you a multiple, but they have done discounted cash flowing. The intelligent, strategic consolidators in our industry all use discounted cash flow model to back into the multiple. I have reached the end. Sorry, I'm going to throw it back over to you.
Excellent.
And I'm going to stick around, and hopefully there's some questions at the end.
That's great. If you can just give me the presentation ability, that would be terrific. Thank you.
You got it. You got it.
Good afternoon, everybody, and welcome to the call. As Paul mentioned, I think he mentioned this, but I also just saw it in an article. Cerulli just did a study, and I think they said that 35% of advisors say they're going to retire in the next 10 years. One of the challenges that advisors have is they don't have a plan for what that eventuality is in terms of succession, as Paul mentioned. And in many cases, they don't know how to value their firm because there are new rules of thumb, as Paul just walked through. And as critically, they don't know what drives value. And the reason that I am so passionate about Trulytics and what Trulytics' mission is to help advisors maximize what they've built to get the most out of their business, even if that doesn't mean that they're going to sell it. Many times people will not be buyers or sellers in the next couple of years, but we want to help them maximize their business, get what they should get out of it. To think of their business as a business, we heard several times today of calling it a practice. I've heard people refer to it as a book. I joke all the time that books are to read and practices for sports and yoga. This is a business, and our goal is to help you look at your business as a business, to give you as much information so you can make smarter business decisions. And for us, that all begins with an evaluation that will not only evaluate your business under different areas, but also will ultimately give you a valuation under a discounted cash flow methodology. So Trulytics software, which is a software as a service that I'll just walk through here briefly, allows you as a business owner in this industry to go in and fill out information on your firm, your ownership, advisors, your clients, your processes, your revenues, and your financials. And that will then generate the report that gives you your discounted cash flow valuation and your score under your business, client, and market stability. So you will see exactly what we believe that the business is worth based on the information that came in, and we will show it to you under other methodologies as well. So very briefly, we ask questions, and this will take roughly 20 to 30 minutes to fill out once you have all the information, but we're capturing information about how long you've been in business, how you're structured, how you register with the SEC, how many owners, advisors, professional, other support staff, who your custodian and broker-dealer are if they are applicable. Then we get information on the owners, their ages, what percentage they have, your advisors if there's more than just you, and you can add or take away as many as you have. We get high information on your client base, so how many clients do you have, how much is your AUM, what's your average client age, how many do you have, how many years have they been with you on average, how many do you add and lose. Every one of these questions that we ask has an impact to the discounted cash flow valuation as we look at that risk premium for that future cash flow. We want to know, how do you acquire new clients? What percentage of your top 5 relationships is, what percentage of your AUM is that? Do you do institutional business? Then we capture all your processes. So do you have continuity plans, succession plans? Amazing that the industry, I think the number is about 30% of firms have written succession and continuity plans. The SEC, I think, is going to require, starting in 2018, that every financial advisor has an emergency continuity plan so their clients know who to contact in case of that emergency. And if you don't have that, that means that they don't know what to do and they're just going to leave. We also capture information on all your technology uses. This is going to help with integration if you are looking to buy or sell, and it will also impact the price. We get the information on your revenues by product area, your net revenue, what your growth expectations are, what's recurring, what do you have discretion over, and that by product area. And then the last page is on the financials. So we get 5 years of net revenue, which shows your growth rate. We get your operating expenses and add backs, and then you will hit save and finish, and that will give you not just your discounted cash flow, but it will give you your Trulytics score. The Trulytics score is basically, think of it as a GPA, which is a 244 in this case out of a 4.0, and that is a weighted average of your business, client, and market stability scores. We show you your high-level firm stats, P&L, your valuation ratios. We are very clear and transparent with the discount factors. We then give you your scorecard, which shows you the areas that you have as potential gaps and how to fix those and what those impacts could potentially be. I will use 2 quick highlights and then wrap up so we can leave time for questions. Many advisors, if you don't have a non-compete, you'll see here that there's a potential $50,000 hit to valuation. If that had been an A, you would have seen an increase in the potential valuation. On the other side, most advisors have heard always you should get client referrals. That actually, for a discounted cash flow valuation, is a negative. We would like to see, or new buyers would like to see, a diversified strategy when it comes to bringing clients on. So it just shows you where some of those gaps are and allows you to make better business decisions on where you want to focus for your business. And then we show you other methodologies as well. So we will show you on not only the discounted cash flow methodology, but also if you looked at a multiple of revenue, EBITDA, or EBOC, which is earnings before owner's compensation, and what the industry standard multiples and roughly what Paul just walked through. So that is the current version of the software. We just launched a new free version. So if you would like to go in, you would go to thetruelytics.com and hit sign up. That will take you to a choice to either get the free version, which will give you your score and your valuation. It will not give you the in-depth analysis. That would be an annual charge of $1,075 or $99 a month, and you can decide whether you want to continue to renew or not. So with that, I will stop, turn it back over to you, Kevin, and let you open it up for questions, and also maybe do the quick poll that we had.
Oh yeah, the poll. I forgot about that. Thanks, Harry. That was great, and thank you, Paul. That's a lot of insight there into how to think about the valuation. So I'll just launch this poll. We'll see if anybody actually sees it. It'd be very exciting if you did. So if you folks see this on your screen, you can go ahead and just click the answer to this question, and we should be able to start getting some feedback on that, which will be fantastic. And in the meantime, we'll go ahead and start asking some questions that came in, and we did receive a few. So I think this one was probably meant for Paul. It says, you mentioned that assumptions matter when creating a discounted cash flow. What are some of the most common assumptions that people misunderstand or underestimate when it comes to discounted cash flow?
A couple of the most common assumptions that they misunderstand is the connectivity to the clients to the principal. I think they underestimate the transferability of those relationships. So that's number one. Number two, they underestimate the age of the clients a lot of times. They see clients have been with them for many, 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 many years. A lot of times we see, though, that those clients resemble the advisor. If the advisor is 65 years old, those clients are typically 65, 70 years old. And again, they're in this distribution phase, and the life, the longevity of those relationships, will begin to decrease over time. The third one I think is as important. And again, this is not a succession planning webinar, but I think a lot of times the folks do not pay enough attention to not the succession as typically thought of as the exit plan, but if I'm valuing a business and I'm looking at a 5-year time frame, the risk associated with that owner not showing up for work. They're probably your primary three. And I would add a fourth too, and I'm sorry about that. I actually would have a fourth. Is the relationship with the next gen is paramount. I have to personalize this. My father owned a construction business for 30 years. His financial advisor was my father's financial advisor. I'm viewed as next gen. I'm quickly approaching 50, and that advisor does not have a relationship with me, and I already have my own financial advisor. So there is a big risk of that. Sorry.
No, I was just going to say that there's an industry study that's been done, and they do it every year at Fidelity and others, where they tell us that 84% of the assets will walk if you don't have a relationship with the next generation when those parents die. So those are pretty big numbers if you don't actually have a relationship with the children or the next generation.
And sorry, it's interesting. So one of the things with Chapel Bridge or other business that works with advisors and helping them work with their private business clients, the big concern we hear from advisors too is not only is no relationship with the next gen, but sometimes with private businesses, that next gen is actually going to be operating the business. And there is a big fear of loss of assets, of attrition of assets after first gen.
Yeah.
Makes sense. So interestingly, I thank everybody for answering the poll. We got some great feedback. Almost 90% of people answered. 45% of people have said that they want to buy a financial advisory business in the next 3 years. 21% said they want to sell one. So you sellers look like you might be in pretty good shape. And 34% said neither. So thank you for answering that. That's great. It actually worked. I'm so thrilled. We have time for one last question. This one might be up your alley, Terry. It says, if a discount starts at 19 to 21%, what is the maximum discount off of cash flow that you would generally see or commonly see?
Yeah, I'll answer it, but then let Paul make comments on it. But so under the business client and market stability areas, you can have a maximum discount of 5. So the total discount on top of the 21 would be 15. So if you had the worst score across all of those areas, you would have a 36% discount.
And I'll just I'll just support Terry on this one. So I've talked to a lot of attorneys and worked with a lot of valuation experts, and they would probably say if you're looking at specific industry factors to apply, to look at additional risk factors, industry specific, the max is you're probably at 40% all in. So Terry, you're right there with your 5% and 15 max.
Thanks.
All right, terrific. Well, it looks like we're just about out of time.
Hey, Kevin, I just want to make one comment based on the survey.
Of course.
There are right now, a lot of people that are looking to buy and a lot of people that are looking to sell. And I got this number recently in the industry last year. For every firm that said that they were up for sale or potentially willing to sell, there were 50 inquiries of people that raised their hand and said that they were interested in buying it. Out of those 50, only 3 firms on average had the ability to do the transaction, either because of their operational structure, their ability for capital, and to pull the deal off, the technology. So it really is not just a matter of somebody's willing to buy. They have to be prepared. And Paul, I know you talk at a lot of conferences about buy side and sell side readiness, and maybe we will we'll do a future webinar on that, and I know that we would want to hear from all of you about what other topics you would like to hear about as we continue to do our web series.
Absolutely, and listen, we really appreciate everybody joining us today. I thought that was a fascinating discussion. As a reminder, this webinar is recorded, and we will make that available to you by email. We'll also be asking you some additional questions about the types of topics you might want to hear about in upcoming webinars. And so if you wouldn't mind taking a moment just to answer those questions when you get that in email, we'd appreciate that. And we invite you to join us next Wednesday at 1 p.m. Eastern Time on the Succession Planning webinar, and we'll send you out some information to sign up for that as well. So thanks again, everyone. Thank you, Terry and Paul, and everyone have a great day. Take care.